let's get in Amit Kalyani on the show to talk about what the numbers look like and the outlook ahead. Amit, great having you. Thanks for joining in. You had mentioned categorically on the call that exports will decline in H2. Should we expect, what, a 15-20% number there? And what are the reasons? Tariffs, weak demand, what?
See, it's a combination of a lot of factors. One of the things that we're worried about is that, when something like tariffs kick in, the the impact on the common man on his wallet takes 3 to 4 months. So we're just worried that what happens after that 3 to 4 months, that impact and the psychological impact. Plus, you have Thanksgiving, you have Christmas. Typically the high spending times of the year for the United States. If that sentiment gets affected, then there's, anything is possible. So I was just being a little cautious and, trying to see that we need to cross that period and see what happens. Obviously, I think even the government there with the shutdown and other things, they're all grappling with all these things and want to bring normalcy back. So hopefully, I think wiser, council will prevail and things will start, clearing up. But unfortunately, anything that happens like this, it takes its own momentum. So it takes time to hit you and it takes time to clean up. Plus, typically, Q3 is the weakest quarter because of these holidays. So, I think it's always better to be cautious.
But because the situation is so fluid, Amit, can it happen that you are cautious, but the situation changes in Q4, even if you don't anticipate it?
Because anything can happen. The US economy is so large that if they, go from a negative mentality to a positive mentality, the flip can be quite large and the whip effect can be very dramatic. Just as the destocking hits you, the restocking can also hit you in the opposite direction. But you have to be pragmatic. You have to focus on your balance sheet. You have to focus on your other expenses. It's very important to control costs when volumes are going down, business is going down, in order to protect your profitability, protect your operations, and to build a moat. Can't let bad times affect your business. And that's when you have to look at new opportunities, look at new products, new segments, and look at where we can double down as well. Because at the end of the day, we need to deliver growth.
Okay. So since you're talking about new opportunities, what are these new opportunities? Can you talk about them?
We have seen that the biggest opportunity on a secular basis over the next 10-15 years is going to be in India. So we are not going to defocus from global. Obviously, we are going to continue to focus on our global markets, customers, products. But while the growth in the global markets may be 5-10%, I think it's possible to grow in India at a significantly higher rate. And it's possible in India to look at growth opportunities in new areas. So that is where we are, focusing on looking at acquisitions, looking at expanding our product portfolio, and looking at doing new things in India, which fit in our core competence. So, our JS acquisition has proven to be, a good experience for us. That is now, on a growth path, and it's giving us a platform to grow in over a multi-year period and multi-sectoral opportunity. The second is our acquisition of the American Axle's India business, which we now call K-Drive. So that's another growth platform that we have created, which will help us play the India opportunity for light commercial vehicles, intermediate commercial vehicles, and SUVs and the passenger car sector. So currently we're on the on-highway sector, and we also want to create an opportunity on the off-highway sector. So that is a Horizon 2 opportunity for us. So these are the kind of things that we will look at.
Okay, there is a contract for supplying artillery systems to the UAE. What's the nature of this contract? Is it a big one?
We have received an order to supply barrels to UAE, and this is our our strategy to deliver MRO. So, this is a revenue procurement. This is not a capital procurement. So, revenue procurement can be more steady. It can give you more of a steady annual business. So, the more of this revenue business that we develop, the more certain your revenue can be. So, you can have 40% revenue supplies, 60% capital supplies. So, at least 40% is rock solid, and out of the 60%, there'll be something that is there every year.
What can investors expect over the next 12 to 18 months, Amit?
I would say next 12 to 18 to 24 months, we will have an overseas business that is profitable.
Which would mean Europe will improve, NA will not be so bad, all of the above?
We will do whatever it takes. So we have multiple options and we are looking at them. I don't think I can say more than that right now.
No, Amit, which is fine. Which is fine, Amit. But what does all of this mean for a Bharat Forge investor? I repeat, over the next 12 to 18 months from a consolidated piece, from a growth perspective.
A strong growth trajectory. I think from 26, 27, you should see a fairly strong growth trajectory. We have multiple growth drivers. We have multiple new businesses which will come into revenue generation mode, profit generation mode, and aggressive growth.
Okay, I think it's ended on the perfect tone. Amit Kalyani, thank you so much for joining in. What Amit Kalyani of Bharat Forge is saying is that there's going to be a strong growth trajectory, aggressive growth starting H2 well into FY27. So you heard it from the man, Bharat Forge. Yesterday the stock was up and about. Today the target prices have been hiked a little bit, but the stock is a bit soft.